Topic introduces the foreign exchange, FX, market and explains its role in facilitating international trade, investment, and capital flows. The foreign exchange market is the global marketplace where currencies are exchanged, enabling businesses, governments, investors, and individuals to conduct transactions across borders. It is the largest and most liquid financial market in the world, operating continuously through an international network of banks, financial institutions, corporations, and brokers. Exchange rates determine the relative value of currencies and influence trade competitiveness, inflation, investment returns, and economic growth. Understanding the FX market is essential for analysts because currency fluctuations significantly affect global financial markets and multinational business operations. Exchange rates can be quoted directly or indirectly depending on the perspective of the country involved. A direct quote expresses the domestic currency price of one unit of foreign currency, while an indirect quote expresses the foreign currency price of one unit of domestic currency. Currency pairs are typically quoted using a base currency and a price currency, such as euro to US dollar or US dollar to Japanese yen. Changes in exchange rates reflect shifts in supply and demand for currencies caused by trade flows, investment activity, interest rate differentials, inflation expectations, and political developments. Investors closely monitor exchange rate movements because currency appreciation or depreciation directly affects international investment performance and corporate profitability. The topic also explains the structure and participants of the foreign exchange market. Commercial banks are the largest participants, conducting currency transactions for clients and managing their own trading positions. Central banks participate to influence exchange rates or implement monetary policy objectives. Multinational corporations use the FX market to settle international trade obligations and hedge currency risk. Investment managers, hedge funds, and speculators trade currencies to profit from expected exchange rate movements. Retail participants also engage in currency trading through electronic platforms. Because the FX market operates globally across different time zones, trading activity remains highly liquid and continuous, contributing to efficient price discovery and rapid transmission of economic information. Spot transactions are a major component of the FX market and involve the immediate exchange of currencies, typically settled within 2 business days. The spot exchange rate reflects the current market price for one currency relative to another. Forward transactions, by contrast, involve agreements to exchange currencies at a specified future date and predetermined rate. Forward contracts help businesses and investors manage currency risk by locking in exchange rates and reducing uncertainty regarding future cash flows. The relationship between spot and forward rates is strongly influenced by interest rate differentials between countries. Analysts use forward markets to evaluate market expectations regarding future currency movements and international interest rate conditions. Exchange rates are influenced by numerous macroeconomic and financial factors. Interest rate differentials play a significant role because higher interest rates generally attract foreign capital seeking better returns, increasing demand for the domestic currency. Inflation expectations also affect exchange rates because high inflation tends to reduce purchasing power and weaken currency values over time. Economic growth prospects, political stability, trade balances, and central bank policies further influence investor confidence and currency demand. Market sentiment and speculative activity may also contribute to short-term volatility. Understanding these drivers helps analysts forecast currency trends and assess the impact of exchange rate changes on international investments and multinational corporations. Overall, topic highlights the critical role of the foreign exchange market in the global financial system. Exchange rates influence trade competitiveness, investment returns, inflation, and economic stability across countries. The FX market facilitates international transactions by enabling currency conversion and providing mechanisms for managing exchange rate risk. Participants ranging from central banks to multinational corporations and investors contribute to the market size, liquidity, and efficiency. For CFA candidates, understanding foreign exchange markets is essential because currency fluctuations affect asset valuation, portfolio performance, capital flows, and global economic conditions. Strong knowledge of FX market operations therefore supports more effective international investment analysis and risk management decisions.